Hello viewers, this is Sunil Javeri, also known as Mr. Bond in the mutual fund industry. This is the concluding video on how do we position Axis Dynamic Bond Fund as a need and a solution approach. This is a very interesting positioning which I am going to showcase to you, which is what we call deferred annuity. All of us are aware of systematic withdrawal as an option available to the investors to withdraw cash for their regular cash flow requirements. Now let's assume that your investor had invested 10 lakh rupees and they deferred withdrawing money to 3 years, and that means in the 4th year onwards is when they started withdrawing money. At 7% if they would have withdrawn, which is 7,200 rupees per month, the residual maturity of this particular scheme would be 12.28 lakhs. And naturally, if you withdraw more amount of money after deferring it for 3 years, because there is an inbuilt cushion available for the investors, at 9%, 9,200 rupees per month, the residual value of that scheme would be 10 lakh rupees. So it all depends on the investors as to how much they wish to withdraw without dipping into the principal by deferring the withdrawals to a certain number of years. Now let's stretch this example to withdrawing after the 6th year, that means deferred annuity after 5 years. Naturally, the inbuilt cushion is higher. They will be able to withdraw higher amounts of money. Instead of 7%, let's assume they withdraw 8% per annum, which is 9,500 rupees. The residual maturity of that scheme will be 13.26 lakhs. They can withdraw as much as 11.75% per annum, which is 13,900 rupees per month. In that sense, naturally the residual maturity value will be on the lower side, in this case 10.09 lakhs. It's a very powerful tool. Create an inbuilt cushion to start with, defer your withdrawals after 3rd year, 4th year, 5th year based on the cash flow requirements of your investors, and this can become a very great tool for the investors to generate regular cash flow, and as you can see, it can be inflation beating cash flows also. The last positioning I would like to discuss with you is how do we position this as a passive allocation through asset allocation strategy. Under asset allocation, as we know, there is equity as an asset class, there is a debt as an asset class. When one asset class, which is equity as an asset class, is expensive and riskier and more volatile, why would anybody take unnecessary risk through credit space by investing in the debt space on the credit side? As against that, if they would invest in a product like Axis Dynamic Bond Fund, become a passive investor, hold it till its maturity, it will take care of the asset allocation which they are looking for, which is between debt and equity. So as I have explained to you, this is a silver lining all of us were looking for, ideal solution in the current debt space, which is turning very, very volatile thanks to the credit defaults, delays and downgrades. Position this Axis Dynamic Bond Fund as a need and a solution. You will get the wallet share and the mind share of your investors. Happy investing. Thank you so much. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.